The broadcast is now starting. All attendees are in listen-only mode.
Okay, this month what we're going to talk about are some alternatives to the paltry money market rates that are out there. And, I just want to begin off by saying it's okay to admit that you hate banks. Okay, you got to, right? Here they get this enormous bailout of our taxpayer money. And how do they reward us? They give us 0.2% on our money markets and CDs. And talking about money market rates, this is one of the top questions I get all the time from clients. Where can I get a higher CD rate? Where can I get a better money market rate? Well, the reality is you're just not going to get good rates in this environment. With most bank accounts paying as close to 0% as they can, shopping around for an extra 0.2% or 0.02% just isn't really worth your time. So what I want to do is talk about a couple alternatives that can give you a little bit higher yield for your money that sits in your money markets and CDs without taking a lot of additional risk. Uh, the first one you should look at are I bonds. Now, I bonds are backed by the government. The I stands for inflation bonds. So a lot of clients, they want to make sure that, yeah, they want higher yields, but they don't want to take any risk. Well, this is as good as FDIC backed, because if the government isn't going to be able to pay back on their debt, then the FDIC fund is as worthless as that. So I bonds are a pretty good alternative, and some of the dynamics on it, you can put up to $10,000 per person per year. So a married couple could get $20,000 into I bonds. The thing about I bonds, there's two components to the return. There's an interest rate, and then there's an inflation adjustment. Now the interest rate right now is 0%. So you might be wondering, why would I want to invest in something with a 0% interest rate? Well, it's the inflation component. The inflation component over the past few years has ranged between 1.5% and 3.5%. So here you get something that's fully backed by the government, and maybe you get 1 or 2% yield or total return on it. So this is much better than what you're going to get at your local bank. And the inflation adjustment is done every 6 months, so you can see exactly what's going to happen with these bonds. The nice thing is you can buy these bonds typically right through your bank. You just call your bank, let them know, hey, I want to buy $10,000 or however much of I bonds, and they can do it right there for you. If your bank doesn't do it for you, then it's pretty easy to go buy them through the Treasury Direct platform. So you can buy them straight from the Treasury Department. Now, there are some downsides for I bonds. The first downside is you have to hold it for 1 year. So if this money in your money market is cash that you're going to have to access for expenses over the next year, you probably don't want to do the I bonds. But if it's just emergency funding that you may not have to tap into, if you keep a certain percentage in your money market that would be there in case you had an emergency, and then any amount above and beyond that, be a great chance to put in I bonds. The other big thing, if you hold it for less than 5 years, you lose 3 months of interest. And right now, again, the interest rate is 0, so you're really not going to lose out much. Another thing to think about are foreign currency CDs. And these are done at a bank called Everbank. You can find out more information at everbank.com. But what they've done is they have created FDIC-backed CDs. So this has the same backing as your local bank. But what it does, it's denominated in foreign currencies. So you could possibly get a much higher interest rate than what you're going to get at a US bank. So for example, I put down here some countries like the Brazilian real, that's yielding 6.45% currently. The Indian rupee is 7.25%, and the South African rand is at 3.75%. So those are rates that you can get by investing in these CDs. Now the thing to remember though, when you invest in foreign currencies, you have currency risk. So currency risk is something that can work for you or against you. For instance, let's say you invest in the Brazilian real. So you're pretty happy about it. You're going to get 6.45% per year. So you're sitting there thinking things are great. But let's say the US dollar appreciates, gets stronger relative to the Brazilian real. So you're not going to get that full 6.45%. You're going to get less than that. In fact, if the real depreciates relative to the American dollar, you could really see that shrink down to nothing. Conversely, if the Brazilian real gets stronger relative to the US dollar, you might get more than a 6.45%. So there is a little bit additional risk as far as your principal here. But the thing is, if you're dedicated to kind of a longer term approach, usually you're going to find that currency fluctuations tend to zero out. And so what you'd get over time is the actual interest rate on these accounts. Certainly there's no guarantee that that would happen, but that's typically what happens. Now again, these things are FDIC backed. So, if the bank goes bad, if the bank goes under, you're going to have the government there to back that up. So the FDIC backs against the bank going bad, not losses in your holdings. So if you invest in a currency and it loses value relative to the dollar, you could have a loss. FDIC is not going to help you out there. It's only going to help you out as if EverBank has issues. But this is another good alternative. The beautiful thing about it is you can add into several different currencies. And in fact, EverBank actually has created some platforms where you can do baskets of currencies. And these baskets are comprised of various different themes. Some of them are based on commodity producing countries. So there you might be in the New Zealand and Australian dollar. You could be in the South African rand and the Brazilian real. They also have some based on countries with low debt. They have some based on geographic. So you have Asia and then you have Europe. So you can really kind of diversify your currency risk using some of these baskets, CD currencies that they've created. So this is just another option to look at without taking a whole lot of extra risk. The third option is kind of outside the box. You're not going to get any FDIC backing here, but you could end up getting a much higher return without a whole lot of additional risk depending on how you approach it. This is peer-to-peer lending. Now let's face it, banks are really nothing more than middlemen. You deposit your money in a bank, and that bank takes that money and loans it out to somebody else for credit cards, business loans, mortgages. So essentially what the banks are doing right now is they're paying us less than 1% to give them their money, and they loan that out at a mortgage of close to 4.5%, maybe business lending at 7%, credit cards at 14%. So they make a nice little spread on your money. Well, what these peer-to-peer lending sites do is they basically cut out the middleman. There's a nominal fee for what they do, but you're going to loan money directly to a borrower. So what this means is you're going to get a higher rate, and the borrower is going to get a lower rate. So everybody wins with this. Now, the nice thing about this peer-to-peer lending, and there's really two sites that I would recommend. One of them is prosper.com and lendingclub.com. These have been around the longest. And what's nice is these two sites do all of the credit analysis for you. They look at the FICO, they look at debt to income ratio, and they look at other methods that they have. And then they categorize the people who are borrowing money from a high rating all the way to low rating. And since these two companies have come into existence, they've loaned out well over $1 billion through 112,000 loans. So, this isn't some fly-by-night operation. This is a very legitimate network. So what's kind of nice is even if you invest in some of the higher rated folks, you might be looking at getting anywhere from 5 to 8% from the people who are borrowing these monies. And then if you do take a little bit of risk and go into some of the lower rated people borrowing money, you're looking at double-digit returns. And what's nice is you get to decide who you loan the money to. You can do a loan as little as $25 and spread that out over hundreds or even thousands of loans. Again, you can get a nice little 5% for if you just wanted to take the highest rated people. And then if you wanted to add a little bit extra, maybe mid-term folks or even low rated folks, you can increase your yield without really having a lot of expected default rates. This chart here kind of gives you an idea for both Prosper and Lending Club, what they've seen as far as default rates for their various credit ratings. So for the highest credit rating for both Prosper and Lending Club, you're looking at below 1.5% default rate. And then for medium term, we're talking between 5.7 and 8.9%. And even for the lowest, you're looking under 17% for default rate. And if you can get, let's say the lowest, and if you're getting 12% yield, that still turns out to be pretty good. Even if you lose 1/5 to default, and you take 1/5 of that interest away, I mean, you're still looking at getting 9% return in an environment where banks are paying less than 1%. So let's just take a look and figure it out. Let's say you take $1,000 and you put that into 40 loans at $25 each. And you do it between highly rated folks and medium rated folks. And let's say that there's a 5% default rate. So at the end, and these loans are usually between 1 and 6 years. So at the end, you're going to get back $950 of your original 1,000. Well, based on that 950, you should be able to get about, I'd say, 7-8% on your return. So that could be, let's say, $78 a year on that 950. So that's an 8.2% return annualized. That's not too bad. That's pretty good. So if you knew that you're going to invest 1,000, and in that year or the next 6 years, you're going to basically get 8.2% back on money that's basically cash, not too bad. Now, there are some downsides for the peer-to-peer lending. The first one's liquidity. So like I said, these loans are between 1 and 6 years. So if you needed to, get rid of the loan, sell the loan so you can have cash, well, it's not as easy to do. Now, both of these have set up a platform where you can go to Folio FM and trade these notes, but there's no guarantee you're going to get the full value of your note. The other downside is not every state allows you to do this yet. For instance, I do a lot of planning in Florida and Maryland. Now, Florida, it's been approved by the Securities Division, so you can borrow and loan in that state. In Maryland, it hasn't been approved to loan money. You can still borrow money, but you can't loan to it. So you have to look and make sure that your state is authorized to do this. But I think this is just another great way to get a little bit higher yield without too much additional risk. And the other beautiful thing I love about peer-to-peer lending is it's basically democratizing banks. We're getting rid of the middlemen, bankers, who have shown themselves to be very poor stewards of our money, as you can see from the bailout. And here we're getting rid of that, and we're going to provide an environment where the people borrowing money can get a lower rates, the people lending it can get higher rates. So those are 3 good ideas for you to get a little extra yield on your money market money without taking too much additional risk. If you have any questions on this, or if you want to talk more, you can feel free to contact me. You can go to picketfencefinancial.com and contact me there, or you can visit my blog at savingyouFromWallStreet.com. At both sites, you can sign up for my monthly newsletter, which will alert you to any new webinars I do, as well as any other information I provide through my newsletters. So with that, I'll let you go, and I hope this was useful. Take care.